So now I'd like to introduce Wally Okby, a senior analyst for Aite Group's wealth management practice, focusing on international private banking and socially responsible investments. He has covered the offshore private banking space for 10 years while living in Luxembourg and Dubai. His mandate was to provide hands-on investor relations as well as private banking and wealth management solutions to ultra-high net worth and family offices in emerging markets. Most recently, Mr. Okby was Vice President of Investor Relations for Capital Good Fund, a US-based nonprofit microlender. Please help me welcome Wally Okby.
Good afternoon, ladies and gentlemen. It's, first of all, thanks to Paula and the good people at Folio Investing and the SRI conference and community. This is my second year attending this conference, and for any of you, if this is your first time here, let me just assure you, this is, it's an amazing setting, it's peaceful, you're sitting and having dialogue with friends and people who share your common interests, away from acrimony. And we're all here for a reason, which is basically to advance our noble agendas in an environment where people are genuinely willing to engage, listen, and support one another. It may not happen today or a week from now or a month from now, but I assure you that the relationships that you make here during this meeting are seeds that you plant today, and they will effectively bear fruit in the near future. So you're in the midst of visionary people, great minds, thought leaders, wealth managers, and dare I say, I believe there's a future candidate for president in our midst here. Maybe not sitting here at the moment, but maybe we'll hear from him or her soon. The screen that you see here is actually a screenshot of when I typed in the words ESG surveys into Google to see what kind of response came. There were 4.4 million hits. Clearly people are paying attention to this. By no means is this just kind of like a fad or anything like that. It's part of the traditional investment landscape. Clearly, there's no dearth of industry surveys and statistics that forecast a rosy demand for ESG within wealth management specifically. In our dialogue with client-facing financial advisors, however, they're not quite as enthusiastic yet, and they usually cite things like poor performance, concern about some of the shorter track records of the products in the space, inconsistent corporate disclosures, and of course different ratings methodologies. Of course there are other factors at play as well, such as general indifference and reluctance to change. If you're a successful advisor, why change? Just continue what you're doing. Nevertheless, there are extensive and deep institutional industry forces at play and driving interest in ESG investment. Just some high-level observations. The intersection between sustainability issues at a corporate level and investment processes and investment allocation models, themes, is taking time within wealth management. There are challenges ahead in sustainable investing, but it's an exciting time. There is a lot of commitment from asset managers and wealth managers to integrate sustainability into their practices. It's happening, and it's happening in a big way. This is nothing new necessarily. Sustainability has existed for a number of years, but in the past it was more exclusionary based. I don't want tobacco stocks in my portfolio. I don't want weapons manufacturers, things of that sort. But today, you can do public and private investments, both on the fixed income and, on the fixed income and equity. So a lot of different options. And we are seeing instances now where clients, particularly amongst millennials, are either approaching their wealth managers with some ideas, or the wealth managers are increasingly reaching out to them with some ideas. And we're actually going to get to one in the next slide, which coincidentally has to do with water. That wasn't by design, by the way, Gary, but that was perfect. So anyway, the problem with, I guess it's kind of like a good problem to have, is there's so much available. How do you select, either as an organization, advisor, or a client? ESG, as I said, ESG has developed now enough to the point that investors can turn to financial advisors or specialist credit managers for guidance. It is now, and I know some people may argue with this, it is now possible to proportionally do good and invest well by conducting in-depth investment analyses and finding the appropriate solutions through a broad-based yet rigorous scan of the market, to include the public and private sector. This figure that you see on the screen here illustrates the ESG and impacting landscape. Let's see where I can see it the best. Yeah, so starting from the top, there's alignment. This is basically where you exclude offensive or include positive themes in your portfolio. Moving down to the right, integration, integrated ESG factors into the investment process, market rate returns, and below market rate returns. We're going to hear a lot about that over the next few days, I'm sure. But I'm quite sure that what we'll hear is that a lot of these high impact investments, which don't typically show up on a wealth manager's radar screen, do generate market rate returns, albeit not necessarily in line with the returns that have been experienced over the past few years during the bull market. So this is the example that I alluded to earlier, and it has to do with a millennial client going into a meeting with his wealth manager, and he basically said, "Look, I've just inherited some money. I know that there are a lot of options out there, but I'm really interested in safeguarding or conserving water." Just that very broad theme. What would a wealth manager do? Any wealth managers, would you just care to say what you would do at this point with that broad statement in mind? No? Okay, we'll try to come back to this later. But basically, what typically happens is wealth manager would go and go into the system and say, okay, look, we have a number of public equities that have high ESG scores, and I've selected for you, and this is what you're going to see on the left, a global apparel company, multi-billion market cap. They use a lot of water. They require millions of gallons of clean water. But they have fantastic ways of processing the water and recycling it, and it's a good investment. It has a projected return of 8% per annum. You can buy and sell it any day you want, and it satisfies your goal of conserving or safeguarding water. However, it's a low impact. On the other side, you have, I'm aware of, as a wealth manager I'm speaking, I'm aware of a regional nonprofit which is focused on water safety. What do? They test homeowners' water supply for lead poisoning in cities like Flint. And if they find that the pipes are deficient or the water comes out dirty, they offer financing to replace the pipes to the homeowners. And that is obviously going to be a high impact investment. The problem with that is that it's illiquid, and the return on that is going to be around 1% per annum with a 5-year lockup. Okay, that's obviously the highest, kind of the highest impact solution out there. And in between, you have mutual funds or ETFs, which invest in companies like the global apparel company, which that contributed to delivery, testing, and cleaning. Highly diversified, they can be global, highly liquid. Maybe you put them into the medium impact category with a projected return of 4 to 6% per annum. So that's kind of like a broad level solution provided by the wealth manager to the client. And I would go so far to say that I think those choices are not necessarily, it's not necessarily the best way to promote what really is available on the market, because there really is much more than that. Key trends impacting ESG development in wealth management, starting with the ESG metrics. I think I alluded to this before. Inconsistent metrics and standards have slowed the interest of ESG within wealth management. This is driving, that's the bad news. The good news is that it's driving innovation, leading to better metrics and standards. That's obviously a pro, and that's something that we can all benefit from, both as wealth advisors and clients. The ESG data, once it's institutionalized, we expect more consistent ESG data, which will drive tighter consolidation of ESG factors into investment selection. ESG factors, with closer integration of ESG factors into the selection process and more accessibility to ESG products, we expect increased demand, or at least increased interest, which is where we ultimately end up on the upper left-hand quadrant. So the common questions clients ask to their wealth managers. There are fuzzy definitions of ESG, and overall wealth management clients, and even ESG practitioners for that matter, struggle with the terminology. The clients tend to ask the following questions. What exactly are the similarities between SRI, ESG, sustainable, impact, value-based, thematic, etc.? How does it belong in my portfolio? Do they generate market rate returns, or is this really philanthropy? How does sustainability contribute to market rate returns, and what are the right benchmarks? And then finally, most importantly, in my opinion, what is the impact of my investment? In the report, I didn't mention this when I first started, but Aite Group is a research consultancy based in Boston, and what we do is we produce a number of reports and do consulting for wealth managers and asset managers, hedge funds, private equity, etc., on a number of different topics. The theme that I personally cover is wealth management. And for this particular report, which we just released last week, we went out and spoke with some of the top innovators in the space to see exactly what they're doing to help strengthen the case of ESG within their businesses. And one of the ones I'd like to, I'm going to highlight only 3 of them, but there are more in the report, and I invite you to talk to me afterwards about this. There are 3 companies which we highlighted. The first is Morgan Stanley. A few months ago, they ran a demo for me and my team, which is a platform called Morgan Stanley Impact Quotient. It solves a really interesting problem that's challenged growth in the sustainable investing within wealth management, which is literally measuring impact as the impact data and reporting is complex and inconsistent. Morgan Stanley IQ offers a new lens with which to view investment portfolios. Supplementing traditional financial reporting and analysis, the application can provide transparency and suggestions across three distinct dimensions of impact: exposure, alignment, and activation. Layered together, these three lenses can offer investors deeper clarity into their current investment holdings and a data-driven approach to further integrating social and environmental objectives across their investment portfolios. First, exposure. Morgan Stanley IQ can shed light on investments in companies with a track record of human rights violations or involvement in the sale of tobacco or firearms. Alignment. Through a holdings-based analysis, Morgan Stanley IQ can highlight investments across a range of themes, such as companies that provide access to healthcare, are working to reduce their carbon footprint, or make gender diversity a priority. And activation. Based on the proprietary asset manager surveys, Morgan Stanley IQ can identify which third-party investment managers take an intentional approach to impact and sustainable investing, including a focus on particular social and environmental issues or the UN's Sustainable Development Goals. We profile this company in our report. The other one, of course, that we profile is First Affirmative, and they're established in 1988, a leading, perhaps the top leading advisor network serving the sustainable, responsible, and impact investment community. They oversee more than $1 billion in AUM and assets under advisement, and they work with 400 advisors, both directly and through third-party partnerships. Its investment philosophy is focused on understanding that the ways people save, spend, and invest can dramatically influence both the fabric and consciousness of society, and that investors bear responsibility for the impact their money has in the world. So First Affirmative works with advisors in three different, in the following manner. Direct relationship. So the advisor partnered with a firm via selling or solicitor agreement or as an investment advisory representative. Clients can access custom managed mutual fund and multi-manager sustainable investment solutions. Asset management platforms. Its SRI strategies are available on a number of third-party asset management platforms and specially curated tools and resources. Advisors can join its optional program that provides discounted tools and resources. A point I failed to mention before is that First Affirmative is owned by Folio Financial. So given the power of data and how it impacts decision making and product design, that combination is quite a powerful one, and it's again one of the companies profiled in the report. The third one I'm going to briefly speak about is InCapital. And they've been a leader in the area of values-based investing for the individual investor. Capital Impact Partners launched Capital Impact Investment Notes, in October 2017. Capital Impact Partners is a nonprofit CDFI, and what they do is they provide financing and technical assistance to underserved communities nationwide. In the US. Through its social impact work, it creates access to healthcare, education, housing, and community development for those most in need. In the past 30 years, Capital Impact Partners has invested billions of dollars in projects that deliver social impact. And so these Capital Impact Investment Notes help expand that footprint. I mentioned Credit Agricole also. They've been a driving force for the creation and development of the green, social, and sustainability bonds market. Beyond acting as a leading structure and book runner of labeled bonds, Credit Agricole is also a leading issuer. Since 2013, the bank has issued from Credit Agricole CIB's Green Notes program, which finances projects contributing to the transition to a sustainable low-carbon economy. The Green Notes follow the Green Bond principles in regard to the use of funds, project evaluation, and the selection process and reporting. InCapital just began distributing these Green Notes in 2018. Oops, sorry, go back. And IFC, the largest international development institution focused on the private sector, launched Impact Notes in March 2014. Their mission is to eradicate poverty and boost shared prosperity by supporting private sector development and job creation in more than 100 developing countries. IFC's projects must adhere to stringent environmental and social requirements, focusing on transparency and accountability. In capital distributed, IFC's first US green bond designed for individual investors, issued through IFC's Impact Notes program in September 2014, and the first US retail targeted social impact note in September 2019. And then finally, the International Bank for Reconstruction and Development, IBRD, part of the World Bank Group, is an international organization that provides project loans and technical assistance to help its member countries in extreme poverty and promote shared prosperity. World Bank is owned by 189 nations, so I think every country in the world, they're also its borrowers. So of these member countries, the US is the largest shareholder, and for over 65 years, investors in the US and around the world have helped IBRD's worldwide activities by investing in World Bank bonds. So we're coming to the end. I know it's almost lunchtime. I hope everybody's hungry. The lunch smells great from here. I'm just going to provide a few key takeaways for a conclusion. Based on the research that we undertook, in order to experience increased adoption of sustainable investing, concerted efforts need to be undertaken in parallel by asset managers, wealth managers, technology providers, and ratings agencies. First, asset managers. Asset managers are the prime allocators of capital. They need to be cognizant of the challenges the world faces, and by and large, they mostly are. They need to determine how companies are situated to respond to those challenges and deploy capital responsibly and transparently to drive positive change. We project increased investor adoption of ESG within wealth management once they see the impact of their investments via proxy voting, direct dialogue, shareholder resolutions, etc. Client-facing wealth managers, obviously they play a critical role. They're the communicator with the end client. Indeed, it's their primary responsibility to engage clients with pertinent investment news and ideas that are in line with customer demand. For example, in the scenario about the client who's concerned with safeguarding or conserving the world's water supply, the wealth manager has to be well informed of the topic. That's no small task. Therefore, the need for technology providers and platforms like Morgan Stanley IQ to fill the knowledge gap. These technology providers and platforms are developing more filtered ratings and benchmarks and pushing the envelope to include a growing number of private investments to stay ahead of the curve. Thought leaders also play a key role in filling the knowledge gap. They have to dedicate copious amounts of time and resources to research, education, and investing solutions to support small-scale wealth managers and advisory firms that just don't have the necessary infrastructure or bandwidth to support growth in this sector. And then, of course, ratings agencies. They play a pivotal role in providing wealth managers and investors with the comfort and assurance they need to deploy capital. We're all aware of the differences in, let's say we are all aware of the differences in ESG ratings from one firm to the next. Providing the raw underlying ESG data can help wealth managers and clients customize the data per their own standards and ultimately generate their own ESG score. And then finally, ESG practitioners' tendency to use the terms ESG sustainable and values-based. They're used interchangeably. It really has to be curbed. Standardized terminology needs to be adopted to just alleviate investor confusion and to invest in an organized, sustainable manner that is consistent with their ideals. I had this screen here because I wanted to see if anybody has any comments or feedback about what our client would do or should do in the example that I stated. Go for the big multi-billion company? Okay, we have one here. I beg your pardon? Yeah, so of course it depends on what type of account the client has with the wealth manager. We're in the era of fee-based right now. Some would say we're moving down toward, particularly in the lower segments, kind of more of a hybrid approach. But you know, if you're in a platform that you're being charged 60 or 70 basis points, you know that's probably what you would be charged for investment into the global apparel company. On the nonprofit, it's going to be higher. It's definitely going to be higher. You see, this is always going to be the case. I don't really foresee any period where, especially in wealth management, where pricing is just coming down, and it's coming down hard. Wealth managers need to scale to stay in business and to be relevant. They have no choice but to keep prices low, particularly in the ultra high net worth segment. The margins are very, very thin there. Maybe in the mass market, they have a little more wiggle room to play. And then, of course, the robos, you know, they're kind of in a class of their own. They could certainly go into a robo and pay, 40, 50 basis points in a robo, or, as you know, most of the companies, most of the brokerage firms now that came out recently, they charge $0 on trades. So I think we're going to have this issue for the foreseeable future. So yeah, in conclusion, special thanks to the companies that we profiled in our report. Calvert Investments, In Capital, Matthews Asia. Matthews Asia is here. I just saw one of their representatives a little while ago. Morgan Stanley and Parnassus Investments. I know they're here as well. First Affirmative Financial Network, Folio, Gitterman Wealth Management. And then some nonprofits, I hope some of them are here today. They have some very interesting stories, and they're profiled as well. Calvert Impact Capital, C-Note, MCE Social Capital, and Social Finance. Thank you very much for your attention, everyone. Bon appétit.